Hey everyone, it is Monday. It is our expert series, and we start off strong. So let's bring back Greg Dickerson. How you doing, sir?
Doing good. Michael, how about you?
I'm doing well. We got a little bit of fires going on here in California, so the air is kind of it's actually difficult to breathe. I won't lie. It's definitely got that smoke in the air, but we're doing okay. We're just staying inside. But hey, it's a pandemic, so we were inside already.
Yeah. So how many miles are you from the worst part of the fires?
I would say there are fires going on in the Santa Cruz Mountain, which by the bird flying would be probably 20 miles.
Yeah.
By car, it's probably like 25 or 26 miles.
Yeah. So you're real close. So I was talking to people last week and over the weekend that are in Southern California, and they have smoke all the way in Southern California, and then going all the way into Arizona.
Yeah. Yeah, we get it really bad in the afternoon. In the morning, it's probably the clearest air because I guess the onshore flow or whatever it is. But by the afternoon, it's bad.
Crazy.
It's crazy. But let's talk about something more fun. Let's
Yeah.
talk about housing. Housing is on fire. The numbers came out last Thursday.
Yeah.
Remarkable. Let me see if I can get them from memory. Nationally, we were up 8.5% year on year. We broke 300K for the first time nationally. Inventory was down from 4.2 months to 3.1. Transactions were up 23.7%, I think. Just all in all, what you and I have been talking about, this market is hot. I think there's ways to take advantage, but we also got to be careful, right? These markets can run hot, and someday something will trip it up. But let's talk about real estate being hot. What do you got?
Yeah, so right there with you. I mean, the housing market is on a upward trend, and it's inventory levels are still at record lows, demand are at record highs. The interesting thing is, where is the demand? Where is it coming from? Why is the inventory low? And what's the future of the housing market, which is all the stuff we're going to, dig into and talk about today, because, a lot of people were calling for a crash, right? Thinking this was going to be the biggest buying opportunity of the century and this, that, and the other. So here's the thing that's very different this go around than last time. Number one, interest rates. Okay. So you got to watch interest rates. Interest rates they hit below 3% for the first time ever. So on, most areas, the average house, 250 to 300,000. I mean, that's less than $1,000 a month for a mortgage, principal, interest, mortgage insurance, the whole 9 yards, less than $1,000 a month. I mean, you can get a brand new house, starter home, for less than half of what you can rent in most areas.
Yeah.
Okay, so there's a long way that can go, from a price standpoint. So it's just like cars. You remember when cars, pickup trucks used to be 30 to 50,000 for a nice vehicle. Okay, that's because the financing was expensive. You were paying 5 to 7% to 10% for interest, and you could only finance a car for 3 years. People don't remember. You could not get 7-year, 6, 7, 8 years of financing on cars. Can you get 8 years now? It might be 72 months, I think.
Yeah.
Whatever it is. You couldn't get that. You could only get 36 to 48 months back in the day. So why do cars cost $100,000, 70 to 100,000 now for a pickup truck and a Suburban? Because you can finance it forever. Interest rates are free, if not low. So it's all about the payments.
Yeah.
Same thing in real estate. So what we're experiencing now is record low interest rates. So it's all relative, except for it's way cheaper now than it was when we were experiencing the boom cycle of the '04 to '09 period, when you could literally buy a house today and sell it for 25 to 30% more tomorrow. That's not happening for two reasons. One, you got to qualify. You got to have, a down payment. You can, mitigate that for first-time home buyers, VA, all that. But still, you got to have a down payment. You got to have good credit. You got to have a job. So the lending criteria is much different, much more stringent than it was back then, when all it took was a credit score. You didn't need any income verification. So it was creating this speculative activity, like we're seeing in the stock, bonds, trade, like we're seeing in that market. Real estate is not a speculative play now, and there isn't an abundance of inventory like there was back then. We can't even keep up now. Home builders can't build fast enough. So that's the difference this time.
Yeah, I think you said a lot there that I agree with, 1,000%, if that makes any sense. First and foremost, certainly owner occupants, they buy on monthly payments. Right. They may look at the price of the home like, hey, home builder is selling it for blah, blah, blah. But that's not the number they're looking at. They're like, what is my monthly payment going to be? Oh, it's $889. Oh my God, I'm paying $1,500 in rent. Makes perfect sense. And then you have You have what I really think is going on, it's starting to bear itself out already in the data, but it will be more obvious in the next 60 days. You have people that were renting ridiculously small places in big cities, right?
Mm-hmm.
The number I have is Manhattan, $4,200 for a 2-bedroom, 1,000 square feet. You can buy a lot of house for $4,200. And if your employer says you can work anywhere, why the hell do you stay in a shoebox? So we have a whole generation, right? The millennials, right? We made fun of them, rightly or wrongly. They were renters on purpose later in life than our generation, right? Gen X. And now they're coming out and they're saying, you know what? We want to own, right? We want a backyard. We need an office, right? They're making fundamental decisions. And I think this is an investable trend. So I think
So think about what you just said. So $3,000 to $4,000 a month in San Francisco and New York for rent for a very small, tiny apartment.
Mm-hmm.
Okay. And what we just said, if you can buy $250,000 worth of house for $800 a month, you're talking about a $1.2 million property. You can go to Nevada. You can go to Charlotte, North Carolina. You can go to the suburbs around Nashville, Tennessee, and you can get mansions. You can go to the suburbs of Atlanta, Georgia. So for people watching, go look at luxury homes in those areas around Atlanta, Georgia, around Nashville, around like Charlotte, North Carolina, Arizona. Look at what you can get for $1 million. You can get 10,000 square feet.
You need to buy more stuff.
Yeah, indoor pools. I mean, it's amazing what you can buy in some of these areas for $1 million. So that's what's going on.
Exactly.
So when you see, the exodus from the cities, and it's a lot of the millennials that are, now they're having kids, they're in their 30s, they want that yard, now all of this stuff, not everything is selling everywhere with multiple offers overnight. I mean, there are properties that are being listed that aren't being sold. And if you look at any MLS in the area, you can see it's really interesting what's selling and what's not and where and why, and how long. And then there's other properties where you get multiple offers, but it's mostly the big demand is the first time buyer, the millennials that are getting out there. That's where the bulk of this is coming from. And it's people that, want to get outside the cities. They want to have that yard in those areas where you can buy a whole lot of house for what you were paying in rent is kind of where the demand and the trends are going.
Yeah. And I think, this is all a demand supply problem. So staying on the demand front, right? I watch my market every day. I write offers every week, which is what, I recommend. If you're going to do one rental at a time, you got to learn your market. You got to know what's going on. So what's going on today in my market and likely most of the country is first time home buyers. So it's where I play, right? Usually below the median or right at the median. But here's the wrinkle that people need to watch for is they need clean properties. They need move in. They need turnkey. Whatever words you want to use, they don't want to come in and do a fixer because they don't want to put in the extra cash. They may not have it, but most importantly is they want that FHA financing, right? One part of the mortgage market that is on fire today is first time FHA 3.5% down, and that means the asset, the house, needs to be clean, right? It needs to pass inspection. It needs to do all of those things. So if you're playing in a market and that's what you're bidding on today as an investor, stop it. You can't win. They can fundamentally spend 10 to 20 grand more than you and have a smaller payment because their interest rate is just that much lower.
Yeah. So that's the question. As a landlord, do you want to own that kind of product? And I would say it's market specific. So in some markets, there's still going to be a demand if you have that housing product where people just want to be closer to work. Yeah. In like my area, where I live, our city is relatively safe. We don't have a lot of the issues that you have in other areas. It's small. And people pay a big premium either to buy or to rent just to be close to the city, to the downtown area, so right now that hasn't fundamentally changed. If things got worse and it got really out of control from a pandemic standpoint, some of the areas that are experiencing the civil unrest and things like that, it's becoming a problem and people are getting away from the city. But there are pockets where, you can kind of hedge that. I mean, there just isn't anything in our market in that 250 range. I mean, very rare does that happen. Yeah,
I can tell you owning, I don't know how many houses we own. We must own 40 or 50 houses. It's a great time to be a landlord of single family homes because again, rents are going up and we don't have a vacancy in a house and we don't, knock on wood, we don't have a non-payment in a house, right? Any of our non-payments are in an apartment building.
So how many of them are qualified buyers? How many of those people could actually buy a house?
You know what? I'll ask my property manager because we have the applications. Obviously, I could get that data, but just from memory, I would guess probably 30%. So let's say I have 50. So that's 15
Yeah.
15, maybe 18. I mean, I know a couple, right? I just approved somebody for a $1,500 rent on a 3-bedroom, 2-bath house, which in my market is great, right? Usually it's 1350. He makes 150 grand a year at PG&E, which is
Wow.
our whatever, our utility company. I don't know if you know who PG&E is,
Yeah.
but
Yeah.
he just doesn't want to own. So I'm like, okay, cool.
Yeah, so that's interesting. Yeah, so I guess there are a lot of people still, well, I mean, I know it's not a guess that don't want to own no matter what. They would rather rent, they don't want to own, even with that kind of a price, discrepancy. And again, a lot of it's area specific and lack of inventory.
Yeah.
So I mean, there is a lot of times more rental product available than there is for sale product.
Yeah, I think that's really what it was, because he just didn't want to deal with it. He was in a
Mhm.
family situation where he needed to move his mom into the back house. It's a nice configuration, all that. But yeah, I think I would say probably 30% of my tenants in houses probably could buy. And that's a good point you bring up, because that's what I saw. The worst time for me to be a landlord was 07, 08. And that's because, again, back to your point, we had stupid lending. All you had to do was have a social security number and a credit score and you can get a loan. So we saw non-qualified buyers become buyers.
Yeah.
And that was, I mean, I was given month away free rent, half off deposits. It was horrible. Thinking
Mhm.
about that now, I wonder. Yeah, I think yeah, it's going to be interesting to watch, because yeah, I'd say 30% of my houses could become buyers. But the good news is I think Fresno's growing. Back to your point about a suburb growing. It's still a place in California. It's crazy. 60 grand a year you can live in Fresno. Its affordability index, which is something I track in Q2, was 50, which meant half the population can buy the average home,
Yeah.
right? That income thing. So lots of room to grow. And I actually just did the math, right? Because again, I've been in the market so long. So back in 06, when I sold that Norris Drive house, the affordability index was like 18, right? So it was like non-affordable. I just did the math, sub 3%. And the median price could go all the way to 450 grand. And today it's 325. So there's
Yeah.
lots of room to run before
Mhm.
we get back to the same unaffordability index.
Yeah,
So
as long as the interest rates stay low, and that's the key metric to watch, because
bingo.
it may not necessarily, be that way. Now, there is no reason to believe, based on what we're seeing, that rates are going to rise anytime soon, but they're going to have to at some point.
Yeah.
You just can't keep going at zero forever. Although we have been close to it since 2000, 9, 10, when
Well,
the whole
let's
zero
scratch
interest
that.
policy started.
Let's scratch that a little bit, because I want to play devil's advocate. First off, I agree with you, but I just want to play the other side because I have fun doing that sometimes.
Mm-hmm.
Let's look at Japan, right? Japan has had zero and negative, at least, I don't know. What do you want to say? The last 20 years, 15
Yeah.
years for sure.
Yep.
Could we in theory have sub 3% 30-year mortgages for a decade? I mean, in theory.
Well, we've had it. We've had close. Really since 2008, 2009. I guess mortgage rates have been hovering in the 3s to 4s.
Fours,
But
yeah,
yeah,
3s to 4s, yeah.
yeah. I mean, we definitely could see it. The problem is that what the Fed is doing now and Treasury is doing now
Mhm.
cannot be unwound.
Yeah.
It can't be unwound.
No, it can't.
Because the markets will tank if interest rates went up. Above 4% now, housing market's done.
No, I agree.
It used to be 5.
Now it's 4.
Now it's 4.
Yeah.
And, so that's just a threshold, and, it will kill the housing market across the board. We saw it happen in the fall of 2018.
It did. I remember.
Yep. It went dead silent all across the country because rates got over 4%, started touching 5.
Yes.
And it just shut off like a faucet. That's the thing about the housing market that's really cool for anybody who's an investor. Trends and changes happen fast within, weeks to months, very fast.
Yeah.
So it's easy to watch. You just watch the interest rates and you'll have an idea what's going on there, and then just watch the inventory levels.
Interest rates are the thing to watch. I totally agree. And I can call it right now. The housing market will slow down when the 30-year mortgage gets over 4%. The question is, when does that happen, right? Some people are saying 3 years. Some people are saying 10. Some are saying never. I don't know. It's not going to be never. Never's too long away. But that's the big question. The other thing.
Yeah, I don't know. I have no idea. I don't have a crystal ball. And then, right now, the way we're headed and the way things are going and the way things have gone, I don't see it happening anytime in the foreseeable future, because the Fed cannot stop what they're doing. We are on a monetative easing QE pattern that cannot be stopped.
No,
Because,
totally agree.
Wall Street's going to throw a fit. And the same thing with the housing market. Anytime interest rates start going up, the markets throw a fit. And I don't care who's in office,
No, I
Republican,
don't care.
Democrat,
Yeah,
it doesn't
I don't
matter.
care. Doesn't matter.
Nobody wants a, meltdown on Wall Street, because that affects everything. It affects banks. It affects everything. And, that would just create such a tsunami domino effect around the world, and all the markets around the world. You just can't stop. We're on that train and it ain't stopping.
Yeah. The other thing to play with is, you and I have never seen sub 3%, but let's just play this angle and go the other way. What happens if it gets under 2% or under 1.5%? The thing that I've been asking myself that question: what would have to happen between now and, call it, next summer, for the 30-year rate to be cut in half? Let's call it today 3%. What has to happen to cut it to 1.5? And I'm like, well, we need to have a double dip recession. We need to have a second wave that is worse than the first wave. We need to be flirting with a depression, right? I mean, I could envision a set of horrible events where the 30-year gets under 1.5%.
Yeah. It's, like you said, it would take, significant contraction, moving forward into next year, to where we have not put people back to work.
Yep.
And it would take the government to stop spending. And I think, again, if we have, a Democratic policy in Washington, I think there's going to be more money put out there, for unemployment benefits, things like that, which people need, right now desperately. But I think it's going to be more liberal of a policy, that kind of disincentivizes production and productivity, which hurts the economy as a whole. So I think, that type of policy, from a political standpoint, will have a big factor on what happens. And then if the Fed has to start reducing rates and go negative, that's when you get, interest rates below 2%, for mortgages and things like that. So they've said they're not going in that territory. The economists that you follow say we can't go negative, but Japan did.
Yeah, Germany or somebody else. I know, not Germany. England? Somebody else did in Europe. Switzerland? Somebody. Yeah, there's
so it's possible, but the question is, will the Fed go there, and is that their floor? Are they because they're not there yet, but if they do get there, is that the floor, and will it stay there?
Yeah. I guess the point of me doing that mental exercise is I can see the 30-year rate going lower, which just kills me, because I remember my first mortgage was like 7.25%, I think, or 7.125%.
Yeah, I bought a 3-2-1 buy down, 9 3/4 first year, 8 3/4 3-2-1 buy down. So 9 3/4 was the interest rate, but first year was 7 3/4, 8 3/4. Third year it hit 9 3/4.
Wow!
Because interest rates were 10%. Now this was 1997. Wow. No, 1990 when I bought my first house. Yeah. And you remember that 90 to 95 was a very slow period. It was tough for real estate. A lot of developers in our area were going bust because they couldn't sell, and that's why we ended up buying that, because the theory behind that was your income is supposed to go up, so in order to get us into the house, that's the program we were on. Yeah. And I mean, this was now what we just talked about. You can buy a $250,000 house now for $800 a month, $850 a month, all in. That first house I bought was $135,000, $125,000, $135,000. It was a 2,600 square foot on a quarter acre, 4-bedroom, with a garage. It was a nice little house. It was a cheap production home, vinyl siding, vinyl windows. And our payment all in was $1,200 something a month. Wow. For I think it was $125,000 house.
There's the interest rate right there. Interest rate impact. That's crazy.
So that's where it's at. So the lower the rates go, the more, housing is going to cost. So it's kind of a wash, right? So the key is the price you pay is permanent. That doesn't go away. The financing is what's temporary. No. Okay. Absolutely. Now you can lock in at 30 years and then, it's, at that point it starts to make a lot of sense. But, the thing about it is that with interest rates where they are now, at a point you just can't go much lower. So if you're paying a premium at that point, there's not going to be much upside from there. And that's why we saw upside in prices in the past, because interest rates, because you remember, our parents talk about double digits when they were paying 18, 19% for their houses. Yeah. Housing prices were way cheaper. Yep. So the only reason house prices have increased, just like anything else, is because the interest rates, the financing is so cheap. So, in terms of a long-term investment, people aren't going to double and triple the value of their houses from here, because you can't. The financing just can only go but so low.
Yeah. So we talked about the demand side. I think there's a lot of positives for demand. I think there's a lot of, I think what I'm getting pretty confident in is, I don't know, 90% of the geography of the US is going to win in this environment. There'll be 10% of the, the big cities who lose, right? Because they're seeing exodus. And, oh, by the way, where I'm going to next is supply. The other thing that makes the big cities tough in this market is that's where all the builder, or not all, but that's where many of the builders were concentrating, because that was the right answer in 2019. Everybody wants to come to cities, build luxury condos, go higher. But guess what? That changed overnight. And now we have an inventory allocation problem, because you don't build houses quickly, right? It's certainly skyscrapers. It takes years to build them. So now we have a lot of contractors, or not contractors, builders.
Developers.
Developers, that's the word I was looking for, who built product that's just coming online in the wrong space.
Yeah.
And right now people are going to the suburbs and there are very few builders there. So you just have more demand, less supply, prices go up.
Yeah. And, it's all works in cycles. So 2008 and 9, we had a condo boom, Miami Beach, everywhere. And there were towers with thousands of units vacant. Vacant. You can move in for free. I mean, they were giving them away.
Yeah.
So, we've been there before, and it was Myrtle Beach. It was, it was all those areas like, Miami Beach, even out in California. And then there was the whole condo conversion where people were taking big apartment buildings, multifamily, and converting those to condo.
Absolutely.
And they all got stuck, right? So it's like anything else. Now, here's the cool thing is that it's actually right now, you're in a very good position as a developer. If you're building a huge tower and there's hundreds of millions to billions of dollars on the line for that building, you're in good shape. Okay. You're going to continue. You're going to finish it out. Nobody wants to see that thing go bust and get sold for pennies on the dollar, right? In terms of the lenders, the bank, the equity.
Oh yeah.
So there's a vested interest in making that work. Whereas 2008, 9, very different. So, a lot of this stuff is going to get rescued and it's going to be able to be worked. Speaking this week, in Wyoming, okay, for, the conference, and the markets are up today because of the anticipation of his speech continuing to say we have a blank check, we have unlimited firepower, so what he's telling the markets is, hey, go do whatever you want, we're here to back it up. Doesn't matter what you do, doesn't matter if you're bankrupt, doesn't matter how inflated the assets are that you're buying and selling, we're going to clean up the mess when you're wrong, so don't worry about it.
Gosh. Yeah, back to don't bet against the Fed, right?
Exactly. Yeah. So that's the other side of the equation, and talking about how does that affect real estate, because interest rates, the national debt, and not only the amount of the debt, but the interest on the debt. Yep. How much can we sustain as a country? How far is too far? And that's a big debate right now, that people say that when debt outpaces GDP, you're in trouble. When does it become unsustainable? Which is interesting. I mean, our GDP is what, 20 trillion, 25, 28 trillion, whatever it is. And the debt's right around there. I mean, debt to GDP is right about 100%. We're almost there.
Almost there.
Okay. Right. Can that go to 200%? Can it go to 300%?
Oh,
so that's the question.
Yeah. So I think you've done some research on this. Again, I've looked at this over the years as, I was an econ grad. So that was always part of one of our courses, as I recall. And what I remember is the only time in the American economy was World War II, right in the depths of World War II, our national debt went above GDP. I could be wrong. I just could have a bad memory. That was 25 years ago. But what have you found when you looked at that?
So it's interesting. I've been studying some economists and people talking about it. And when you look at history and you look at other countries that have gone, 100 and 200% to GDP,
Japan,
they're fine. Japan has not had, their inflation has remained pretty flat, while their debt has gone up. So the evidence is, well, you can do it forever. You can go and you can do it forever as long as you can service the debt. So if you think about the national debt, like we think about leverage of investments, as long as we can service the debt, if our GDP is, 28, let's just say $30 trillion, just
for math,
for a round number of GDP at 30 trillion, what kind of a payment does that mean that we can pay for our debt? Well, if you think about an investment, you can lever that up, 3 times, right? So that means that we could have $90 trillion worth of debt that we could sustain. Yeah,
that's I mean, when we tie this back to this whole conversation, interest rate is the thing to watch, because again, the national debt is often financed in the bond market, right? With, different maturities. There's talk of a 100-year bond coming, right? I've heard that talk over the years. They've obviously the 30 years out there. So one of the things that we will see as the debt ticks up and rates stay low is the government will go longer in duration.
And see, that's the thing that Powell and Mnuchin are talking about. They're like, why can't we double it? Why can't we go 200% debt to GDP? You know what I mean? Because as long as interest rates are low, you can sustain that.
Yeah, I mean,
you can make the payments.
They just did it wasn't, I don't know who the buyer was, but somebody just did a $1.2 billion junk bond. Junk. Yeah, like 1.87, just something sub 2%, right? So yeah, I mean,
So essentially, for people listening,
scary.
that's a bankrupt company issuing debt that people are buying for them to stay in business when they're already bankrupt.
Yeah, exactly. It's crazy. Yeah.
And who's the buyer?
I don't know. Probably the Fed, right? It has to be the Fed. They're going to be the big buyer, right? The Fed's going to, a lot of zombie companies out there right now. But I mean, when you go back and look at this and you tie this whole conversation together, I think interest rates, so I've already changed my opinion on interest rates. I was originally thinking interest rates would be going up by kind of 2025, right? Just because I think we're going to get back to kind of where we were by 2022, heading into 2023. We're flexing our muscle. We're feeling pretty good. And I'm like, okay, the Fed will keep it low for a little longer. Then 2025, we raise. Right now, at this point, I've changed my mind.
You just picking a number?
Yeah, I was just picking a number, right? Because I just couldn't see us staying this low.
So what drives it? So what is the catalyst to drive interest rates up? So the only thing that can drive interest rates is real inflation.
Yes.
Okay. So if, at real inflation, when I say real inflation, what I mean is at the consumer level.
Yes.
When, gasoline is $10 a gallon, when milk is $10 a gallon, when that shirt you're wearing is $100.
Exactly.
At Walmart.
Yeah.
That's real inflation. That's hyperinflation.
Agreed.
So the Fed can't allow that to happen. Okay, so that's what we haven't seen, and we haven't seen it since 08 and 09. We've seen inflation at the asset level because of the liquidity and all that, which is fine because that doesn't affect the average consumer.
Correct.
When an automobile is $300,000 or $200,000, that's when you got a problem. So that's when you'll see interest rates tick up. But the only way that can happen is if the economy is firing on all cylinders, like it was pre-pandemic, and people are spending a lot of money like they were pre-pandemic, but we still didn't have hyperinflation because the consumers will pull back and they'll start putting money in savings. And that's the big mistake that like Greenspan made and Bernanke and a lot of the central banks, pre-2008-9, they weren't looking at real inflation indicators, consumer inflation, consumer prices. They were looking at assets. They missed it. That's why we had 2008 and 9. So they're now watching consumer spending, consumer price index way more closely now, and they understand at what point they have to do it. So if that starts to happen, if let's just say all of a sudden the government just writes everybody a check, relative to their income and replaces every nickel that was lost and then doubles that, whatever, kind of like they're doing at the asset level of Wall Street. Let's just say every American got a check from 100,000 to $1 million based on your income. Okay. Then what happens? Man, then you get hyperinflation at the consumer level because they're going out and just buying whatever.
Right.
Yeah. So.
Yeah, I don't think I'm back to that. I could see interest rates on 30-year mortgages staying below 3% or certainly below 3.5% for a decade.
Yeah, you need a really, really strong economy with significant consumer spending to drive inflation in order for those rates to tick up. And then here's the problem. When they do that, market tanks, assets tank. Housing market stops. So it's a very interesting thing that I've been studying lately is, how and when does that happen? What's the effect of the dollar during all this? What's the effect of the dollar? Let's say we double our debt to GDP. How does that affect the dollar? Is the dollar going to remain the reserve currency of the world? Is there a point at which the world says, I no longer want the dollar?
Yeah.
It's very interesting.
So is it fair to say that you're bullish on real estate for the next couple of years?
Yeah, I think it's fine. So market specific, deal specific. So again, I'm all about the deal, not the market, not whatever. If the deal makes sense for you and your return level and what you're after, the deal makes sense. You just got to watch and make sure that if you're, buying and flipping, building and selling, that you're watching very closely: interest rates, demand, inventory levels, all that. And you want to get in and get out quick. You don't want to be multi-year speculating right now.
Yeah.
Big development projects are going to take multiple years.
So just so we
That
put
I'm
a
not-
time frame on that, when you say get in, get out, say sub 9 months.
It depends on what it is. The smaller the project, the quicker. But,
Sure.
larger projects, yeah. I mean, you can safely predict right now, 6 months to 9 months, maybe a year out on bigger projects.
Yeah.
But, right now, if I can get in and out in, 30 to 90 days, that's kind of where you want to be.
Yeah, I was just trying to get the end. I agree with you. I think you could see up to a year. I don't know that I would sign up for something that's 18 months, 24 months, because we do have this, oh, by the way, election in November, and that could gum things up.
Yeah, we've got that. We still have the issue of, the coronavirus and all that. What are the real effects of that? How's it going to look going into the fall and winter? That we don't know yet.
Yeah.
So once we know that experiment and we see what's happening, then we can make some more intelligent decisions about longer term investments. But right now, I think if you're speculating, you want to get in and get out quick. Rent's rent. Okay. So if you base your buying criteria on actuals and say, I'm happy with the return right now, if nothing else changes, and I can sustain, again, accurately calculating risk. If I can hold on a downside or if this thing backs up, then you're fine.
Exactly.
But anything speculative, you got to be real careful.
Yeah, I think that's exactly what I teach and talk about in one rental at a time, right? Is if you can do the deal now and it hits your return, and oh, by the way, the market tanks and you lose 10% but who cares? You can hold it. It doesn't matter. So be conservative. No negative cash flow in this market. Yeah. So any closing thoughts, Greg, as we wrap this up?
Yeah, I think it's exciting times. I think it's very interesting times. There's a lot of, things to research out there, but I think, again, know your market, make sure that you're not stepping outside of your threshold of what you're looking for in terms of returns, whatever you want for cash on cash, whatever you want for cash flow, those types of things. Don't bank on, appreciation.
Never.
You need to always plan that it's going to pull back and go the other way, and that interest rates are going to go up and we're going to see some inflation. So you need to think that way.
Yeah.
And, just know your market, know your deal, and, just be careful and pick your spots.
Awesome, Greg. This has been a great expert series. Love kicking off the week with you. I appreciate you, man. Have a great week.
Yeah, man. A lot of fun.
Yep. Thanks.